So Eddie, what should foreign investors do now? What's your tips?
Just sell everything and go live the nomad life.
Eddie's got the open checkbook. He's open to all that.
Live the nomad life, just stuff it all.
Revenge.
Now look, like I always say, don't panic. Like at the end of the day, really it's not the end of the world, right? There's always ways, you just gotta find them. Obviously all this is new. It will get clearer with time. You just need to take your time, ask the right questions to the right people. That's very important, asking the right questions to the right people and understanding what your options are. So existing properties are expected to remain protected. So if you're an investor already, then
Hi everyone and welcome back to another episode of the Brokers Lounge, joined again by my esteemed, wonderful colleague Eddie.
Thank
How are
you,
mate.
Thank you, mate. I'm very good. How you doing?
Another week.
Another week.
Yeah, it's busy.
It is busy.
It's really busy. So it's a good and interesting busy, I think. Probably the best way to describe it.
Yeah, I think the best way to describe it is like sitting in a pressure cooker.
Hope we're not about to explode.
Well, hopefully not.
Yeah, you're probably right. Yeah, and look, it's probably great segue for today's topic because we're going to continue on with the theme of the federal budget and one of the recent changes they announced to that, and that's all around negative gearing, which is throwing a bit of a spanner in the works for us when it comes to helping our clients determine what their borrowing capacity looks like. It's definitely having a bit of an impact, or actually having a massive impact. So we're just going to talk through what the proposed changes look like, what effect it's going to have on property prices, whether it'll increase, we'll see rents increase, and obviously how it's going to impact borrowing capacity going forward as well. So let's probably get into it. I think the first way to start off would be what's actually changed.
So we discussed the capital gain changes last week.
Yep.
We'll focus on the negative gearing part for this week. So basically effective 1st of July 2027, negative gearing on new purchases for properties that are not newly built will be abolished. So this will not be part of your tax strategy or lending strategy moving forward. And you'll just have to find different ways of making this work, because removing negative gearing from lending, it can have a huge impact on how much you can borrow.
Yeah.
And I guess that is the aim of the new rule. It's to reduce borrowing capacity for investors in particular, which will put them outside the market in a way, which will hopefully open the door for first-time buyers and owner-occupiers to be able to purchase those properties. So we'll see how that will work, right? Because I think in a certain way, investors who wanted to purchase a property, let's say for $1 million, all of a sudden they can't afford $1 million anymore. And now they have to find a budget within the $700,000 mark, which puts them in competition with the first-time buyers entry point, right? And this could have the opposite effect in terms of pushing first-time buyers out of the market again. Because a lot of investors, even though negative gearing can be helpful, but a lot of investors will still want to purchase investment properties for the growth that they can generate and for the wealth that they can generate over time, regardless of the negative gearing effect. So we'll see how that plays out in the months to come.
They'll probably just change tack to a certain degree, won't it? They'll just, like you said, instead of $1 million price range, they'll go, okay, well, we have to lower our sights and go for that $700,000 mark, and we'll still find something.
Absolutely.
There's definitely properties out there. So
yeah,
it's not like they're going to be cut out of the market altogether.
Exactly. People will still go about wealth creation. They just need to find different ways, different assets, different entry points. So the whole thing will change, but something new will come out of it. It's not like it's dead and no one's buying investment properties anymore, right? So this is going to change. So basically, Negative gearing concessions will effectively be limited to newly built residential properties from 1st of July 2027. So if you buy a newly built or you build an investment property, then negative gearing applies. And that's strictly for residential properties. So commercial properties are exempt, and self-managed super fund purchases, if you purchase a property in your self-managed super fund, that's exempt, even though that doesn't have much of a benefit because it's in your super anyway. Existing investment properties purchased before the changes are expected to be grandfathered, and obviously we're waiting on any amendments to the legislation, and if it passes, which I think it will. So if you have an existing investment property, this will be exempt. And what we've been doing over the last couple of weeks, people with investment properties, existing investment properties, are starting to change tactic in terms of how they treat this debt. Because if you've got an on-rock debt and an investment debt, a lot of people are now changing, if they haven't already, the investment loan into an interest-only loan, so that they can prolong it for as long as they can and benefit from the negative gearing while focusing on paying off their on-rock debt. Losses could instead be carried forward under the new rules against future investment property income. So once the property is sold, and if there's any gains you've made, the carried forward losses that you have carried over the years, that can be brought forward, reduced from the gains, and can have a tax benefit. So this is
Could take
what is
time too.
Yeah.
If you've got a property that's currently negatively geared, to get to a point where it then becomes positively geared and you can then start offsetting some of those gains, then geez, that could be years and years down the track.
Exactly. So yeah, they made it harder in that sense. Maybe it's also important for people who are not fully aware of what is negative gearing. So it's basically investor owns a property making a yearly loss. Under the current system, that loss reduces your taxable income immediately. So the property lost $15,000, your taxable income is $100,000. Instead of paying tax on $100,000, you pay tax on $85,000, which could see you save $3, $4, $5,000, depending obviously on your bracket and income.
A lot of people look for that big fat tax refund at the end of the year as well.
Exactly. Now, under the new proposed system, the established properties lose that immediate tax benefit. So there's no benefit there. Newly built properties would still retain concessions because the government wants more homes built. So bottom line, this could significantly reshape the investor behavior and strategies over the next few years. We'll see certain markets push up. I don't know, I could think that newly built properties will be pushed a bit more. Will probably put more constraints and more cost to the construction process. And the government wants new homes built. This could have the opposite effect, where it just puts more pressure on an already stretched out industry, and it can have the opposite effect. So we'll wait and see.
It's going to, like I think we've discussed ad nauseum this week, is like, this is just proposed changes as well. Yes, it's obviously been announced through the budget, but it's not legislated yet. The issue that we're finding at the moment is that even though it's not coming into effect until 1 July 2027, and it hasn't passed through legislation, a lot of the banks are starting to look and go, okay, do we need to start imposing the changes now, effectively immediately? I guess from a responsible lending point of view, they're looking and going, well, if these changes are going to flow through down the track and we're approving loans on the basis that negative gearing is available as of today, then we're probably not assessing the client correctly as well. So that's probably the hard juggling bit that we've got at the moment, is that, client, even though it hasn't been passed through yet, clients are already being impacted with certain lenders.
Exactly.
There are some that are like holding fire and sitting back and going, we'll wait to see what happens, or we'll have some interim measures in place. But yeah, it's definitely having an immediate impact, that's for sure.
Absolutely. And yeah, like we said, it will have its effect on the property market. So I discussed it briefly. So if you want to go more into depth.
You like I said, you've just touched on it briefly, but obviously the investor demand for those established properties will start to diminish very quickly. where there's properties where there's very low yield, typically investors will go, okay, that's fine because I've got good capital growth there. The low yield doesn't bother me because I can cover that shortfall because at come tax time, I'll get a fair chunk of that back anyway. They're probably going to move away from that focus as such. So, or like you said, change tack a little bit. I guess what that all potentially means is that first home buyers, like you said, may face less competition at auctions. I'm not 100% convinced on that because I think it'll actually, like you said earlier on, could potentially have the opposite effect. So, I think we may see that. And there will obviously be that big focus on new builds. I think we'll see a lot more house and land packages coming through.
Flogged.
Yeah, exactly right. And, will off the plan purchases come into vogue again? I don't know if there's enough stock in order to do that as well, because typically a lot of those off the plan purchases were done like inner city apartments and stuff like that. So I think we've got enough of those already on the market. I think the developers and the builders are probably going to benefit the most from these changes because, as we know, if there's a greater demand for newly built properties, we know what's going to happen to prices.
Exactly.
They're definitely going to start pushing up. So, and some critics will argue that fewer investors in established housing could reduce rental supply. And we know what happens when rental supply is reduced.
Which is already a tight market anyway.
Yeah, exactly right. Yeah. And the other thing is, if there's more demand on newly built properties, will our construction sector be able to meet those type of demands as well? Because they're already stretched. We've already seen a lot of builders or construction companies go under as well. So will there be enough capacity there to be able to build the properties quick enough to cater for all these changes as well? So, I think it would probably a good segue to talk about, and we touched on this very briefly, does this improve affordability? And I think it's probably talk about the borrowing capacity impact of these changes.
Yeah, so from a lending point of view, as we said before, in the past, a lot of investors relied on negative gearing for servicing, and that improves your servicing heaps really because it's adding a lot of income back into your taxable income, right? So as you said, some lenders have started changing the rules in terms of when they're assessing affordability, they are removing negative gearing on the basis that this will be the way moving forward, and they're pretty much protecting themselves from any risk in the future. So we are starting to see a lot of investors already dropping heaps in how much they can borrow. Like we've got pre-approvals in place, and they could.
We had one example, and I think you almost mentioned numbers earlier on the other day, where
$1 million,
loan bounce. We unticked the tax deductibility part of it, and it dropped down to $700,000. So that's
exactly
30% drop.
Exactly. So that's huge.
Probably one of the biggest impacts we've seen in lending far back as I can remember.
Yeah, it is.
And I've been around for a while. It reminds me.
It is huge, and we're just going to have to deal with it and change expectations. It is what it is, right? We can't change it. You just got to have to work around it. You got to find ways to make it work somehow. So the potential servicing impacts is investors purchasing established properties after the reforms they borrow less, they need stronger income, they need larger deposits, and the focus will be more on cash flow. Because it will be really important to be as close as possible to breaking even, if not positively geared. So positively geared, if they exist, properties may be far more attractive, but with the current prices, which are already high, and rent yields around 3 to 4%, it's really hard to get a positively geared property. So the strategy might shift to prioritizing rental yields. That's a very good one, dual income properties. And that is a strategy that a lot of people focus on, where you buy property with potential to build a granny flat or another unit at the back. And then you've got two rental incomes coming, which will help a lot with the yields. Lower debt levels also. So investors putting in more cash towards the purchase and borrowing less. just to be able to sustain, right, repayments and not be bleeding cash out of your already taxable income. So the buy now and rely on tax deductions later strategy may become less common. Self-employed borrower impact. Borrowers, self-employed borrowers are already like, I don't know what's the...
It's not a nice way of saying
nice word. Yeah, they're stuffed, right? So,
well, it's hard. I'll make it nice.
Please.
It's difficult at the moment.
it is, yes.
And it's going to get more difficult.
Yes, exactly. Thank you. So,
I know where your thought process was heading on there.
So it's what we're seeing is tighter servicing assessments for self-employed. A lot more questions asked, a lot more scrutiny is done towards vetting them. So we'll see how that impacts them. Reduced tax deductions also will definitely lower borrowing capacity. And look, at the end of the day, clients can still do something. You can still borrow, you can still qualify for lending. It's just you need to strategize more around the property you want to buy, the level where you want to enter the market, and focus around growth mainly. Like you really need to find properties that grow, because that is the only part that will benefit you down the line, right? If you're buying an investment property that's not growing in value and you're just bleeding cash,
what's the use?
What's the point?
Well, they got a crack casino.
Right.
But on black.
Oh, exactly. So there needs to be a bit more strategy around what you're trying to do. In the past, people would just go buy whatever property they find and it will work. This is changing. The landscape's changing. You really need to understand the market, where you're buying, why you're buying, what's your 5, 10, 15-year plan, and the impacts will have on your cash flow and income. So
it's interesting because from a cash flow point of view, you think, I don't know, when I bought the beach house and being rented out, I didn't buy it on the basis that I was getting a tax deduction. I was buying it for different reasons because I knew that from a cash flow point of view, I still had to wear those costs, the interest costs, everything else. So I still had to build into my cash flow what the difference was going to be. I wasn't banking on the fact that I was going to get a nice tax deduction come tax time. So the issue is basically around most people can fund these purchases without the tax deduction. The issue is when the banks start looking at serviceability, that's where the key is, because, not only that, they're building in that 3% straight buffer as well. So the new yearing used to almost counteract that as well. So we're not having that now. So now it's like, you've got to be able to fund it out of your cash flow and also fund it on the basis that rates could go up and by another 3%.
100%.
That's where people are getting really caught out. Because I probably sit back and go, I can still afford it. Cash flow tells me I can afford this.
Yeah.
So why wouldn't I do it? But
exactly. When it comes to the lending side, it's dead.
Yeah, exactly.
100%.
Right.
So who do you think are the winners and losers?
Yeah, I think, we talk about the first home buyers. There will be pockets where first home buyers will be the winners out of this because they're not up against as many investors. There will still be investors out there who will look to purchase the properties that these first home buyers are looking at. But I think they'll be one of the winners. I still think the developers and builders will be the bigger winners out of all this. If I was a builder, I'd be focusing on specializing in granny flats. Like you said, that dual income is a big one, and they could be a massive. And then there's still a lot of properties out there with ample land and have the ability to do it. And I've seen a lot more people starting to get costings around what a granny flat's going to cost them.
Yes.
So, the issue is obviously around purchasing a property
with the potential,
and then being able to have enough equity in order to, especially if you want to borrow to build the granny flat. Because if you don't borrow, then you're going to have the funds to actually build that granny flat as well.
Yeah, and probably, on that topic, what I think might happen is people who've got like 2 or 3 investment properties where, because we've seen this strategy a lot, getting into a 600K market and buying just an investment property. That strategy might change and people would consolidate instead of having 2 or 3 investment properties, buying 1 investment property with that potential. Because to get into the dual occupancy where you've got a granny flat, then you're looking at $1 million plus probably, right? With construction costs and all that sort of stuff. So
and the yield to go with it straight away as soon as you can. The other winners will obviously be investors who want to purchase new builds or really interested in that. areas with strong new housing supply. So I think those local areas, especially at the suburbs that are growing in the outer suburbs, outer suburbs in the various capital cities, will definitely be one of the winners in all this. Potential losers, obviously, investors that have been focused on established properties, because as an investor, you typically want to see what you're getting, what the return is going to be. Pretty much see the numbers are all there, ready to go. When you purchase it as an investor, if you're purchasing a new build, there's a little bit more unknowns. You don't really know what it's going to be worth.
Yep.
When it goes to settle, you don't know potentially what the rental return is going to be. So it becomes a little bit more difficult. We've mentioned this a few times, buyers that are heavily reliant on those tax deductions. So if you're banking on that every single year, then you're probably going to be one of the bigger losers. And what else? What was that?
Bigger losers. Loser.
Biggest loser. But I guess from an existing investor's point of view, if the grandfathering rules are going to help you, will continue to help you. Thank God they're grandfathering that rule there. I think we'll see investors probably hold on to properties, like I said, for a lot longer now. So they'll strategies around switching from principal interest to interest only, or extending interest only terms in order to keep that property a little bit longer, keep the deductions going on longer as well. So I think the discussions around the government reforms, so obviously aimed at improving housing access for the younger Australians out there. The critics out there will argue that it discourages everyday Australians from building wealth through property investment. And I think we may also see a change in tact from an investor point of view, whether they'll look to invest outside of property. There's still other ways of being able to gear into the market through shares, managed funds.
Yeah, true. And I think obviously wealthy people will not be affected as much as normal, I don't know what's the word, average or everyday, like you name it, like people who are hustling and trying to get ahead in life, and property was one of those vehicles they could invest in and help them push forward in life. So now you need to hustle a little bit harder to be able to get into the investment market.
Yeah. Well, property has always been good because Australians fall in love with property because you can see it, you can touch it, it's there. Investing in things like the equities market, you have no control over it.
Yeah, and you have everyone understands
what companies you invest in and stuff like that, but you don't have control as to how those companies operate.
Yes,
and their performances as well. Whereas, property is a little bit easier and probably easier to understand as well.
Absolutely, yeah.
So Eddie, what should foreigners and investors do now? What's your tips?
Just sell everything and go live the nomad life.
Eddie's got the open checkbook. He's open to all offers.
Live the nomad life. Just stuff it all. Now, look, like I always say, don't panic. Like at the end of the day, really, it's not the end of the world, right? There's always ways. You just gotta find them. Obviously, all this is new. It will get clearer with time. You just need to take your time. Ask the right questions to the right people. That's very important, asking the right questions to the right people and understanding what your options are. So existing properties are expected to remain protected. So if you're an investor already, then you just need to work around your cash flow and
review
your structure.
Yep.
How can you sustain your existing structure and cash flow, and how can you tap into any opportunities that might arise? Okay, so it's really important if you're an existing investor to go through your cash flow, your loan structure, your long-term investment plans, and your future purchasing strategy, and see what you can benefit and what you can do to remain in a good position. Now, new investors need to do a bit more work there, so you need to focus or just really understand if you want to get into the new build. Do you want to buy a new built house and benefit from the negative gearing part? Do you want to find a higher rental yield and pay a bit more to get into that market? How are you going to manage your debt if you're not getting any negative gearing benefits if you don't do like the new builds? And genuinely understand if you can afford the investment property, regardless if you can get the lending for it. And that was actually my take on people buying in trusts, right? Because trusts are treated the same way as these rules. And people would go, just buy in a trust. You don't need to service the existing debt and just buy another property and buy another property. But reality is, you got to service these debts at the end of the day, right? Regardless if you can get the funding for it. So you really need to understand what you can do and if you can really afford it. First-home buyers, obviously, there could be less investor competition in some areas, but there can be more first-home buyer competition as well. So you just got to wait and see. Affordability still remains on interest rates, on the supply, on lending policy, and your wage growth. So obviously at this stage, we've got high interest rates, we've got the negative gearing being abolished. So lending is really tight at the moment. So take away tax policies, the new tax policies will affect borrowing capacity. They'll change investment strategy and lender servicing outcomes. So it's very important. Good finance structuring and cash flow planning are becoming a lot more relevant and important than ever. And I really mean that. Like, you really need a good mortgage broker. You really need a good accountant. You really need a good financial planner to get the full picture and understand what you can, what you can't do, and how can you use existing rules for your benefit. So that's it pretty much. Closing. Obviously, the government is trying to redirect investment toward creating more housing supply and improving affordability, which is not fully working, but the long-term impact on prices, rents, and borrowing capacity remains the major debate. And we're going to have to wait and see how that impacts, changes with time. The thing that is clear for now is that investors and borrowers will need to pay closer attention to cash flow and lending strategy moving forward. And we'll keep you posted with any updates and how there's ways to get through and around this. Until next time, thank you for listening. As usual, send us any questions, leave us a 5-star review, and we will see you soon. Thank you.
See you later, everyone.
Bye-bye.
Bye.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Head to the show notes if you want to book a free call to discuss your personal situation.